Television. I'm Sakshi Batra, and this is an earnings special edition. And our focus today is on Mahindra Logistics. Remember, it's a company which is an integrated logistics and mobility solutions provider. It offers supply chain solutions to industries such as auto, consumer goods, pharmaceuticals, as well as e-commerce as well. Now, as far as the earnings are concerned, the company has announced a net loss for Q4 to the tune of 12.8 crores. This is as compared to a loss of 0.8 crores in Q4 of FY23 last year, same quarter. So the loss has widened this time around. The company's operational revenue has seen an increase of 14% to 1,450 crores as compared to 1,272 crores in the same period previous fiscal. EBITDA has experienced an 11% decrease to 56.6 crores. The margins have also come down. They've come in at 3.9% in the reported quarter compared to 5% in the corresponding period of the previous fiscal year. Now, to discuss in detail what do these earnings really mean for the company, what is the growth outlook for the company as well, joining in is a very special guest with me. The top management of the company, Mr. Rampraveen Swaminathan, the MD and the CEO of Mahindra Logistics, is with us. Warm good morning to you. Thank you so much for taking the time out for this discussion, sir. First up, if you could elaborate for all our viewers, what has been the key reason behind the increasing pressure on the bottom line, sir?
I think there are really two parts to our earnings. Obviously, as you mentioned earlier, revenue growth is actually strong in the fourth quarter compared to some earlier quarters where it was more muted demand environment. From an earnings perspective, the core business, which is our contract logistics and global cargo forwarding businesses and our mobility business, that actually had a pretty stable quarter in terms of earnings, both on a year-on-year basis and a sequential basis. Those earnings are obviously impacted from due to some one-time charges, which is what drove lower reported earnings, one-time charges on account of some discontinued accounts, and in terms of the cost of a large IT transition we did this year, which resulted in kind of Q4 one-time costs. Set out those one-time costs, which are approximately 12 crores at a pre-PAT level, you would note that the business was actually pretty stable in terms of profits. The other part of our business, which has been our express acquisition, which is, we see that independently as a long-term investment, which we are making in the business. And that business, I did have a challenge over the last few quarters on account of integration. But on a sequential basis, we are now improving the results quite significantly. In Q3, losses came down by 10%. In Q4, losses in that business came down around 26 to 30%. So, it's really two different parts. And, we think the underlying business, the core business is actually in a good shape. Growth's coming back. There are some strong tailwinds there. And as the express business flips, and we expect that to be EBITDA positive by the end of the first half of the year, we actually do think that there'll be a fairly big flip in earnings, which is right now covered by a couple of these factors.
Okay, so you are hopeful of turning EBITDA positive as far as the first half of the fiscal year is concerned. What about the bottom line, sir? By when do you see that coming into black?
Yeah, so the express business should hopefully be at a run rate level, be positive, PBT positive by the end of this fiscal.
Okay. So, since you said that, some of your core businesses have been continuing to do well, and your operational revenue, we've seen a 14% increase. What were the key contributing factors, and do you see those as continuing key growth drivers for you in the upcoming quarters? Do you see a shift over there? What do you see? Which segment do you see taking the lead now?
I think we had two big challenges in the first 9 months of the year. One was, I think, consumption markets, end markets are a bit weak. E-com especially was a bit softer as we saw some capacity churn by our clients. I think both of those have now turned around, and we have seen strong order intake now in the last couple of quarters almost on FMCG, durables, and e-commerce. Automotive still remains pretty stable, and I think that will continue to drive growth, especially in our contract logistics business. The other part which has been challenged has been our global cargo or global cross-border logistics business, which has been impacted heavily by macros, but that's at least bottomed out now. It's bottomed out. We reported the sequential growth in that business, and I think as volume comes back, we'll see a stronger uptick there.
Right. So you did talk about volume, and I did want to ask you on the volume growth picture going forward from here. How do you see it shaping up?
I think as you know, we are a derived industry. We serve other industries in general, and I think speaking to all our customers, I would expect probably volume for us to come back probably to a mid-teen growth level. That's what we are hoping we can actually deliver this year, right? If everything goes well, order intake has been robust over the last couple of quarters, and we expect that will continue. We obviously have to convert that to and execute them. It takes 4-5 months to execute each project, but we hope that that's the level of headline growth we are aspiring to this year.
Okay, so also wanted to take that bit of understanding from you. We did see that both ATF as well as diesel prices, they declined, year on year in the fourth quarter, 2% and 7% respectively. Were they able to offset any part of the muted volume growth this time around, and how do you see that factor really playing out?
Well, the way we contract out, we pass on the cost and the benefit of fuel price index changes to our customers. So obviously, when the costs go up, we pass it on to our clients. And as they come down, we obviously pass the benefit to our clients as well. And so our financials are fairly neutral to fuel changes, fuel price changes.
Okay. As far as the demand outlook is concerned for your key manufacturing sectors like autos and industrial goods, how do you see that playing out in the upcoming quarters, sir?
I think auto, obviously had, within auto, obviously commercial vehicle is still a bit weaker, but three-wheelers being robust. I know passenger vehicles obviously are close to an all-time high. Growth will probably not, in the coming fiscal, not be at the same trajectory of the last couple of years, clearly, but we do see fairly robust, growth outlooks, right, from at least our clients. So that's something which we are positive about. The consumers' goods space, both durables and FMCG, has started upticking. We are started seeing some network expansions by our customers there. So pretty positive about that as well. And e-com's kind of bottomed out. And we're positive in the coming quarters that we will start seeing an improvement in e-com, if not a breakout, at least in stronger and consistent improvement.
Okay, so just last two questions. One on the EBITDA margin outlook. Right now, 3.9% did see a dip. Where do you see sustainable margins panning out for this fiscal year? And the second question will be on the revenue growth outlook as well. Where do you see the top line really headed in FY25?
Yeah, I think on revenue, as I said, we are hoping to get to a double-digit early teens kind of growth across the entire basket of products. Obviously, the forwarding business is a little bit more challenged because of global macros. And from a margin perspective, while we reported 3.9% at an EBITDA level, I think you have to take off your sans the losses we have in the express business at an EBITDA level. Margins were north of 5%. And so a big part of our growth focus is really on solving the losses in the express business. This was a really good quarter in terms of improvement, and we hope to be EBITDA positive in that business through the first half of this year. And as that happens, I think you will start seeing the EBITDAs get back to the 5% because it's really it's not across all the business. It's one business, investment in one business, which is kind of dragging the rest of the numbers.
All right. Well, all the very best to you, Mr. Swaminathan, and thank you so much for speaking to us on Business Today Television. Truly appreciate your time with us, sir.
Thank you.
All right, viewers, we will wrap it up at that. That was Mahindra Logistics for you. One key business that is an overhang as of now, but the company is confident of turning EBITDA positive in the first half of the fiscal year, a double-digit growth on the revenue front as well as the volume growth also could sustain as far as the EBITDA margins, which have come down to 3.9%. They also see an improvement over there going forward from here. Many thanks for tuning in onto this earnings special edition, but do stay tuned onto Business Today TV as we continue to get you all the insights from the world of business, finance, and even stock markets, and also what's passing. Stay tuned. Don't forget to like and subscribe to our channel.